Throughout history, every financial crash has wiped out fortunes, destroyed businesses, and left people in ruin. But in the midst of chaos, there have always been a few individuals who saw what no one else did, who dared to go against the crowd, and in doing so, made generational wealth in a single move. A recent example is Michael Burry, the man who shorted the housing market in 2008 when everyone believed the housing market could never collapse. He spotted the cracks in the system that others ignored, and when the crash came, he walked away with hundreds of millions of dollars. But this wasn't the first time something like this happened. Nearly a century before Michael Burry, there was Jesse Livermore, a trader who saw the warning signs of the 1929 stock market crash, signs that most people dismissed. While others were euphoric, he was skeptical. While others bought stocks, he shorted them. When the Great Depression hit, he made an unthinkable amount of money, over $100 million in 1929. In this video, I'll break down why the 1929 crash happened, how Jesse Livermore predicted it, and the exact strategy he used to turn a disaster into an opportunity for himself. The stock market crash of 1929 wasn't just a sudden event. It was a ticking time bomb fueled by years of reckless speculation, excessive leverage, and blind optimism. When the collapse finally came, it wiped out fortunes overnight and sent the world spiraling into the Great Depression. But what exactly led to this disaster? Let's break it down. Throughout the 1920s, the US economy was booming. Industrial production was rising, consumer spending was at an all-time high, and businesses were flourishing. Automobiles, radios, and household appliances became widely available, fueling demand and economic growth. The stock market reflected this optimism. Between 1923 and 1929, the Dow Jones surged from about 100 to over 380, a nearly 300% increase. Investors, both seasoned traders and average citizens, poured money into stocks, believing prices would rise indefinitely. This speculation of the investors was driven by several key factors: easy credit and margin trading. During the 1920s, banks and brokerage firms were offering extremely high leverage to investors, often with just 10% down, meaning they could borrow up to 90% of a stock's price. Investors could buy $100 worth of stock with only $10 of their own money, borrowing the remaining $90 from the broker. This high leverage allowed even small-time investors to control large amounts of stock with minimal upfront capital. However, this 10-to-1 leverage was a huge risk, because even a small drop in stock price could wipe out an investor's capital, which would trigger margin calls and demands from brokers for additional funds. If investors couldn't meet these margin calls, brokers liquidated their positions, causing a chain reaction of forced selling that accelerated the market collapse. This excessive margin trading was one of the biggest factors that turned the 1929 decline into a full-scale financial disaster. Lack of financial regulation. At that time, the financial system lacked oversight, which allowed banks and brokerage firms to engage in risky lending and speculative investments. On top of that, the newspapers and financial experts encouraged the belief that stock prices would never fail. The famous economists of the time even claimed that a new economic era had begun, where crashes were impossible. This overconfidence led to stock prices rising far beyond their fundamental values, creating one of the largest speculative bubbles in history. This price rise was not forever because by early 1929, cracks in the system started to appear. While the stock market continued rising, industrial production and consumer spending began to slow down. Companies reported lower profits, but their stock prices kept soaring, creating an unsustainable disconnect between market valuation and economic reality. The Federal Reserve was concerned about excessive speculation, so the Fed raised interest rates to cool down the economy. This made borrowing more expensive and put pressure on leveraged investors. Farmers, who made up a significant portion of the economy, faced declining crop prices and increasing debt, leading to financial instability in rural areas. And by the summer of 1929, financial experts started warning that the market was overheated. Some investors paid attention to these warnings, but many dismissed them, believing the bull market would continue indefinitely. The crash, a domino effect of panic selling. The crash didn't happen overnight. It unfolded over several days, with key moments accelerating the panic. On September 3, 1929, the Dow Jones peaked at 382. Because of this, many investors remained optimistic, believing the market was still strong. But just 50 days later, on Thursday, October 24, 1929, a sudden wave of selling hit the market, with 12.9 million shares traded. It was more than triple the normal volume. Because of enormous selling, the market started to decline. Then, major banks at the time intervened and started buying stocks. It stabilized the market. This day is known as Black Thursday. Just 4 days later, on Monday, October 28, 1929, the sell-off resumed with even greater intensity, with the Dow Jones dropping nearly 13%, making it Black Monday. On the next day, on October 29, 1929, a full-scale panic started, with 16.4 million shares changing hands. Stock prices collapsed, wiping out billions in wealth. Because of such a massive sell-off, the panic started and the Great Depression had begun. While millions of investors were devastated by the crash, Jesse Livermore saw it coming and positioned himself to profit. Jesse Livermore was one of the most famous speculators in history. Known for his ability to analyze market psychology and identify bubbles, he made and lost fortunes multiple times before 1929. Unlike most investors, Jesse Livermore wasn't just focused on price rises. He meticulously studied market behavior, volume trends, and psychological sentiment. As the stock market soared in the late 1920s, he became increasingly concerned by what he saw. One of the most alarming factors he noticed was the excessive margin buying. Investors were borrowing up to 90% of stock prices to buy shares, which artificially inflated the market because most of the demand came from borrowed money. Livermore knew that if the market turned even slightly against these investors, then they would face margin calls that would lead to mass selling, ultimately triggering a panic. He also observed an unsettling level of euphoric speculation. People who had never invested before, like cab drivers, waiters, and housewives, were suddenly pouring money into stocks, discussing stock tips as if they were seasoned traders. From his experience, when uninformed investors rushed into an asset class, it often signaled a bubble that was ready to burst. Jesse Livermore not only stopped on normal human behavior, but also closely tracked corporate earnings and economic data, and he noticed a dangerous disconnect. Despite soaring stock prices, some companies were reporting declining profits. This told him that the market was no longer being driven by fundamentals, but purely by speculation. By mid-1929, he observed a crucial pattern. The market continued to hit new highs, but the rallies lacked strong conviction. Even though the market was achieving new highs, the trading volume was declining, meaning fewer buyers were pushing stocks higher. And after some time, some leading stocks stopped making new heights even if the overall market climbed. On top of that, many stocks were hitting new lows. For Jesse Livermore, this was a classic early warning sign of a weakening market. These indicators suggested that the bull market was running out of steam, and from past experience, Livermore knew that when a bubble starts running out of buyers, a crash is inevitable. As Jesse Livermore knew the market would crash, he uniquely positioned himself to profit from the upcoming collapse. Livermore was a seasoned trader, and even before the 1929 crash, he had made millions during 1907 and 1917 by shorting the market. He had a unique advantage that other people did not have. Livermore had his own money, unlike most traders who were invested with borrowed money. He had no significant long exposure and had access to massive amounts of stock for shorting through his Wall Street connections. Because he used his own money, he wasn't at risk of margin calls, which would have forced him out of his position prematurely. Instead of shorting everything at once, Livermore built his short position gradually. He first shorted weaker stocks that had stopped making new highs. As his predictions started to play out, he waited for confirmation before aggressively adding to his position. He also knew how to navigate short-term market rallies. When stocks made small recoveries, many short sellers used to panic and close their positions too soon. But Livermore held firm, recognizing those as bull traps and temporary bounces before an inevitable deeper crash. His mastery of reading ticker tape movements gave him a further edge. By the time the crash of October 1929 unfolded, Livermore was already positioned for massive gains. While the rest of the market was in free fall, he walked away with a fortune, cementing his legacy as one of the greatest traders in history. He started his short position with $50,000, and at the end of the crash, he made $100 million. In today's terms, it is about $1.8 billion. After making such a huge amount of money, Jesse Livermore couldn't keep his fortune intact, and over the next 10 years, by 1940, he lost all of his money and was in huge debt. The story of Jesse Livermore is strikingly similar to that of Michael Burry. Both the 1929 and 2008 crashes were fueled by speculation, easy credit, and the belief that markets would never fail. Livermore and Burry were among the few who saw the danger ahead and acted accordingly. Their success came from their contrarian views and their willingness to go against the herd. One thing remains true: history repeats itself. The next financial crash isn't a question of if, it's a question of when. The real question is, will you see it coming, or will you be on the wrong side of the trade? If you don't want to be caught off guard, subscribe to the channel. Learn how to navigate the markets, spot warning signs, and make smarter financial decisions. Watch this video to see how Michael Burry predicted the 2008 crash and dive deeper into the crisis with this playlist.